Today I'm going to teach you how to use the mortgage calculator that I developed for my business, and I'm going to teach you how to use it because it's really simple. But first, let me give you a disclaimer. This mortgage calculator gives you very accurate information. It will never replace the job of a loan officer. So my recommendation is that if you have any questions in regards to mortgage financing, to loan programs, payment analysis, etc., please consult with your loan officer. Having said that, let me go ahead and show you how easy it is to use this calculator. When approving for mortgage financing, there's two things that are important. Number one, obviously, is the monthly payment. The other thing that is important is the down payment. And the last part that is important is your ratios. Now, let me explain you what ratios are just very easily. Imagine that your salary, your gross salary, is a chocolate cake, all right? And then you said, you know what, I'm going to take a piece of the cake because I'm going to eat a piece of the cake. You cut that cake and you take a little piece out of that cake. That's what we call a ratio. That little piece out of the cake is what we call a ratio. So for mortgage financing, there's two types of ratios. We have what we call the government ratios, and then we have what we call the conventional ratios. And the government ratios basically says the following, that if you are going to purchase a property, your mortgage payment should not exceed 45% of your gross income. And the reason why your mortgage payment should not exceed 45% of your gross income is because you would have 55% left over to pay for other things such as gasoline and utilities and food and groceries, medical expenses and things like that. So the government says, we believe that if your mortgage payment does not exceed 45% of your gross income, then you should be okay. And this is the gross income of everybody who's going to qualify for the loan, because you can have multiple people qualifying for the loan. That's the first ratio. The second ratio is what we call the mortgage payments plus credit or consumer debt, what we call the consumer debt. And the consumer debt is anything that shows on your credit report. Now, if it doesn't show on your credit report, it's not consumer debt. So let me give you some examples of consumer debt. Credit cards, student loans, personal loans, business loans, car loans. Those things show up on your credit. There's also other things such as child support, taxes. If you have a payment plan with the IRS, will probably show on your credit and so on. Those are the things that show up on your credit report. That's what we call consumer debt. Your mortgage payment and your consumer debt should not exceed 55%. And when I'm saying 45, 55, I'm talking about the limit. You should always aim to be lower than that, somewhere 41.50 or 41.51 or 52, something like that. But if you go to 45.55, you're right at that borderline that if anything happens, if your fire insurance policy is higher than expected, or you have, for example, flood insurance that is going to be added to your monthly payment, you will reach over that limit and you no longer qualify. So you have to be very conservative with these numbers, okay? So that's the first part. For conventional loans, the ratio is a lot lower than that. The ratio for conventional loans is 39% and 43%. That's what you need to know right now in regards to the payment for that property and the amount of income that you need. So in order to calculate this, we're going to start very simply. We're going to put a purchase price of a property. So let's say we're going to do a $400,000 purchase. And we're going to put the amount of down payment for FHA financing, which is the most popular of the government programs. FHA financing is 3.5% down payment. VA is 100%, so it's zero down payment. And then there's other programs that require a little bit more, but for government programs, that's basically the bottom line. It's either 0% for VA, 3.5% for FHA. Conventional loans start at 5%. So conventional loans can go from 5%, 10%, 15, 20%, and obviously you can give more than 20% if you want to. But for right now, we'll do a government program, an FHA program, so we're going to do 3.5%. So I'm going to do 3.5% down payment here. It automatically tells me what the down payment is going to be. So 3.5% of $400,000 is $14,000. Then the next part is interest rate. I don't know what the interest rate is going to be on the market when you receive this video, so you'll probably have to go and figure out what the interest rate is. You can just go to Google and put what is the current interest rate for FHA 30-year fix, for example, and you'll probably find something that tells you what the interest rate is. For today's example, I'm just going to use 4% just to round it off. So 4% interest rate, and then the term, which is the term can be 10 years, 15 years, 20 years, and 30 years, and there's some for 40 years, but they're not very popular. So stick with the 15, 20, 30 year plans. So 30 year in this case. Okay, once you do that, you will see then now here we have the analysis. And it says this is principal and interest payment, property taxes, fire insurance, and mortgage insurance. Now, mortgage insurance, if you're not bringing 20% down payment, you will be hit with mortgage insurance. The only way to avoid mortgage insurance on a conventional loan is to prepay the mortgage insurance, and you need to talk to your loan officer about that choice, because it does cost some money, but that's the only way to get rid of mortgage insurance if you're bringing less than 20%. If you're bringing less than 20%, you will have to pay mortgage insurance. And then HOA, if the property has an HOA. Now, one thing that I do want to mention regarding this is that if you put here 20%, what's going to happen now is that the mortgage insurance is going to disappear, because you're bringing 20%, then the mortgage insurance disappear. Obviously, if it's an FHA mortgage or a government program, mortgage insurance is required no matter how much down payment you bring. But if you're going to bring 20% down payment, it makes absolutely no sense for you to go on an FHA program, and you can go on a conventional loan for that matter. 20% will remove the mortgage insurance. Another thing is that if you have an HOA, usually the HOA pays for the fire insurance policy. So once you put HOA here, the fire insurance policy disappears, because most homeowner associations, they have a blanket policy of insurance throughout all of the units, and then your homeowners association payment includes the insurance, and that's the reason why I put it in there. If you needed to add something else, for example, mellow roofs, you can also add it in here. Some properties do have mellow roofs. Consult your real estate agent in regards to what mellow roofs is. So if you wanted to add mellow roofs, you can just add it there as well. Okay, so we're gonna zero this out again. We're gonna go back to the original part. And now what we need to figure out is the ratios. How much income is required to qualify for this mortgage? So the first thing that I'm going to start putting here is going to start putting the gross income of the person per month. So let me give you some quick calculations of income, okay? If you work on an hourly basis, it's going to be your hourly rate multiplied by 40 hours a week, multiplied by 52 weeks a year, divided by 12 months. And we always multiply by the amount of weeks and divide by 12, because you have to remember that every month has a different amount of weeks. Some months have 4 weeks, some months have 4.5 weeks, and there are some months that have 5 weeks. So if you want to have an accurate number, then my recommendation is you go by a weekly basis, multiply by 52 or 26 by weeks if you want to, and then divide it by 12. So let me give you an example of that. Hourly rate will go something like this. Hourly rate times 40 times 52 divided by 12. Now if you get paid bi-weekly, it will be bi-weekly payment multiplied by 26 weeks divided by 12. And that's basically how you calculate income. So it's not complicated, but if you have any questions regarding that, always give me a call. So in this case, I'm going to say that the hourly rate for this person is let's say $39 an hour, multiplied by 40 hours, multiplied by 52 weeks, divided by 12 months, gives me a payment of $67.60 gross income. Now we see here the ratio is 39-39, which is very good, okay, but we're not done yet. Even though we qualify for the mortgage based on the income and the housing expense, we still have to see if we qualify based on the housing plus consumer debt. So I'm going to make a big example here. Let's say, for example, this person owns 2 top-of-the-line Mercedes-Benz, and each Mercedes-Benz payment is $630, so that's $1,300. If I put $1,300, you will see now that the ratio is 58%. You're outside of the ratio. You would not qualify for this mortgage based on this criteria, because you're outside of the 55 for government loans. So 45-55, remember that, right? So in this case, you would need more income, you would need less consumer debt payment, or you would need more down payment, or you would need a lower loan amount. That's the only way that you can reduce your ratios, is by a combination of certain things. Most people say, what about if you reduce the interest rate? Interest rate is not going to drop your ratio too much. I would suggest to you that 0.25% interest rate or 0.5% interest rate only drops your ratio by probably 0.5 point or something like that. It really doesn't work that way. So you need to lower your purchase price, increase your down payment, increase your income, or reduce your debt. So in this case, I'm going to reduce the debt. Let's say that this is a normal person, has a payment of $350. So there you go, 44. Let's say that they have a credit card payment. The minimum payment on credit card, you don't go by how much people actually pay, because people sometimes pay more than the minimum. So if their minimum payment is $40, sometimes they pay $100. You go by the minimum. So in this case, let's say it's $40 a month. And then let's say that this person has student loans. So the student loans is, for example, I don't know, let's say $350 a month or something like that. And this person doesn't have any other payments. So as you can see here, the ratio is 39.50. You should be okay for financing on when it comes to FHA. But if I were to go on a 5% conventional loan, my ratio is 38.49, which is too high on the consumer debt, because remember, for conventional loans, the maximum ratio is 39.45. So at this point, I'm already outside of the ratio for consumer debt. Even though I would have qualified for the housing, the ratio for consumer debt is too high. So what I would need to do is I would need to either defer the student loans payments, or I would have to reduce the payments, or I would have to pay off my cars or something like that. You would have to reduce your debt, so to speak, okay? So basically, that's how it works. This is the calculator. I can run 50 different scenarios on it, but you would have to play around with it and make sure that you get to use it and you get to understand how it works. Another thing that I forgot to mention, if you're gonna receive rental payment from any property, let's say additional units or something, always remember that you take the rental payment and then you multiply it by 75%. And the reason you want to do that is because underwriters will always take off 25% for vacancies and repairs. So let's say, for example, if this person was going to buy a duplex and the second unit pays $1,500, then you multiply by 75%, that's $1,125. You add it to their base salary, that's $7,885, and you just put it in here. Let's do another scenario. Let's jump this number to $650,000 because I want to show you something else. As you can see here, this person would not qualify on a government loan because the ratio is 54:63, which is completely outside of 45:55. In this case, the only thing we can do is we can increase the down payment. Let's say we increase it to 20%. All right, that will bring me to 4251. Now they're good to go. Or the other choice is to increase the income. Let's say 9,500, and there you go, 4553. Okay, either that or we need to basically reduce the purchase price, and let's do 550 just to check, and that's 46, still a little bit high on the housing, so we'll do 525 for example, and that'll bring me 4453. So once again, playing around with the numbers, you'll figure out how much is the maximum amount of payment that you or your clients can qualify for, and also what your amount of payment is going to be, and also you're going to figure out how much income you need and if you have to reduce consumer debt or not. And that's in a nutshell how the calculator works. Once you have input the numbers here, there's another thing that I'm going to give you, which is the closing cost estimate. This is not a good faith estimate. This is just an estimation of closing costs and down payment that you can use as a reference point. Please consult your loan office in regards to this, but this will give you a fairly good idea how much your closing cost is going to be. The cost of purchase for the property in this transaction will be around $5,500, which includes processing and underwriting, escrow fees, title fees, and things like that, things that you cannot avoid basically. And then you also have reserves. So you have interest reserve for, I calculated for 15 days. You have insurance reserve for 14 months, and you have tax reserve for 6 months. So the total reserves in this case is going to be 9,303 for a total closing cost of 5,516 plus 9,303 is 14,819, and the amount of down payment is 18,375. So the total funds needed to close is a minimum of 33,194 for this particular transaction. So if the transaction was, let's say, 350,000, you will see here that the numbers will change, and that will be $10,000 for closing costs, $12,000 for down payment, for a total of around $22,000 needed for funding. And the rest of it is an amortization schedule, and there's also a couple of flyers that you can use if you're going to open houses and things like that. If you have any questions, give me a call, send me an email. Have a fantastic day.